The week ahead is going to be very busy from both a top-down and a bottom-up point of view. And two key items of news will dominate in terms of economics. On Thursday the 7th of March, the European Central Bank will announce its latest interest rate decision. President Mario Draghi has already stated on several occasions that he expects the headline rate to be anchored at zero for some time to come. And the bank stopped adding to its quantitative easing bond buying scheme in December, having gradually tapered it down from a peak of 80 billion euros a month. However, Signor Draghi and fellow executive board member Benoit Cœuré have already expressed concern about a softening of Eurozone economic data. Monsieur Cœuré has even been dropping hints in late February that the ECB could extend its TLTRO, Targeted Long-Term Refinancing Operations. Now, they were launched back in 2016 to provide banks with cheap funding so they could provide cheap credit to help economic growth. Stock markets may like the idea of more of this cheap cash, but I do wonder whether this raises deep questions over the health of the banking system and the Eurozone economy in general if the ECB feels a need to go back to its bag of monetary tricks a grand total of 8 weeks after it stopped adding to QE, let alone talks about even withdrawing it. Then, Friday the 8th of March, we get the latest US non-farm payrolls and wage growth data. Investors, economists and the US Federal Reserve will all be watching this like a hawk, or more probably in the Fed's case like a dove. In theory, the stronger the jobs number and the faster the wage growth, the more likely the US Central Bank will be to reach for its 10th interest rate hike of this cycle, and first of this year, and keep withdrawing its QE scheme at up to $50 billion a month. But at the January and February meetings, the Fed seemed to put rate rises on hold, saying any future decisions would be data dependent, and Chair Jay Powell even said he could calibrate the QE withdrawal if the economy slowed. Now, the jobs and wage growth numbers will be key in influencing Fed thinking, even if markets are currently putting a 97% chance on no change in the 2.5% headline interest rate for the March policy meeting and an 88% chance of no change by year end. What's interesting here is the January non-farm payrolls number was a belter. America added 304,000 jobs and wage growth came in at 3.2%. We can see the trend in both numbers here over the past 5 years, during which time the average monthly gain in jobs has been 215,000 and wage growth's averaged 2.5% a year. But the January numbers also looked odd because unemployment went up from 3.9 to 4%, helped by some rather complex seasonal adjustments. We've also had the US government shutdown since then. The February number is therefore expected to come in lower and with some adjustments of its own, which may allow the Fed to maintain its studious stance. But, like ECB policy in Europe, this raises the question, if an economy where unemployment's near 50-year lows and wage growth is rising, and it can even take interest rates of 3%, what's the Fed worrying about? And what does that say about the debt-soaked foundations of the economic upturn since 2009? But then, financial markets haven't really cared too much about such niceties so far, feasting off the cheap liquidity provided. Company-wise, we've a long list of FTSE 100 and mid and small cap firms who are scheduled to report interim or full year results. They include the following, and note it's a particularly big week for insurers, both life and non-life. On Monday the 4th of March, we've got engineers Rotork and Senior, brickmaker Ibstock and building contractor Keller. On the 5th, we've got bookmaker GVC, Direct Line, Phoenix Group and Intertech. On the 6th, another bookie, Paddy Power Betfair, plus Legal & General, Just Eat and Recruiter Page Group. Then we have Aviva, Admiral, Spirax Sarco Engineering and Melrose, the proud new owner of GKN, on the 7th. And finally, Bodycut and building materials specialist SIG on Friday the 8th of March. But for all of the interest that that lot could spark, the stock that could really cause a fuss in the week ahead to me is Ashtead. The equipment rental giant's due to report third quarter results on Tuesday the 5th of March. As we can see here, the shares fell very sharply in the second half of last year, albeit from their all-time high, as worry gathered over global growth. But they've rallied very strongly in the early stages of 2019 for two particular reasons. First, investors have been looking for a settlement in the US-China trade dispute, And second, as we've just been discussing, the US Federal Reserve has begun to take a softer line on monetary policy, and that's been easing concerns it would overdo it and snuff out the US economic upturn in the process. Both issues particularly matter for Ashtead because around 90% of group sales and profits come from America via its Sunbelt subsidiary. As such, these results should be interesting if you're already a shareholder in Ashtead, you're thinking about it, or you just want an insight into the US economy. Analysts will be looking at two headline numbers in particular. The first is sales. On a stated basis, Ashtead's been generating sales growth pretty consistently in the mid-teens for some time. By way of a benchmark, it racked up revenues of £916 million in the third quarter of last year. Note that Ashtead will also publish adjusted figures, which allow for foreign exchange movements. The second number to watch, well, that's pre-tax profit. Again, growth here has been consistently running in the mid-teens, with the exception of the fourth quarter last year when bad winter weather hit hard. Ashtead recorded stated pre-tax income of £194 million in the third quarter of last year. And again, management will release an adjusted number which excludes exceptional items and amortisation of goodwill and adjusts for currency movements. Three other items worth bearing in mind are the ongoing share buyback programme, spend on bolt-on acquisitions, which had reached £362 million at the half-year stage, and particularly capital investment. If management is feeling bullish about the future, it'll be buying more kit so we can rent it out. At the interim stage, CapEx was up 50% year on year to just over £1 billion. That put Ashtead on track to easily exceed last year's £1.24 billion investment. But watch for any changes in the growth rate as a means of maybe second-guessing management's outlook on trading. Thank you for watching, and I look forward to seeing you next time.